Thank you, Terry, and thank you everybody for tuning in today. I plan to make it worth your while. I've actually been in the financial services business for 35 years. Most of that I did helping people prepare for retirement. But the last 13 years, I've devoted exclusively to Social Security. And I've traveled all over the country giving live presentations to folks such as yourself, a lot of financial advisors as well. And speaking exclusively on Social Security, what I'm going to share with you today is the same presentation I've used. Let me just take a minute and tell you how I got here, because my last stint in corporate America, I worked for the best company I ever worked for, which was New York Life. In the last 3 or 4 years there, what I would do is I'd travel all over the country training financial advisors on retirement income planning. Once you retire, have an income plan so you have enough money to pay all your bills and enjoy retirement. And I did this, and a lot of places, companies had financial or retirement income planning software. We did too. And I quickly realized that one of the first pieces of information you put in that is your Social Security income. And a lot of people, when they would create these retirement income plans, they hadn't retired yet, so they hadn't claimed Social Security, but they needed to put something in there. And I quickly realized that if you increase that Social Security income, it can have a dramatically positive impact on the retirement income plan. So I'll be honest with you, at the time in 2007, 2008, I didn't know anything about Social Security. So I decided to educate myself. And from the moment I did, I was blown away. I had no idea Social Security allowed people to do the things it allows them to do, had these great features and benefits. And I also realized that hardly anybody knew this stuff, because back then I would go to all these, great national sales meetings and all these conferences and stuff, and they'd have all these outside speakers come in and speak on different topics, and nobody was talking about Social Security. So that's when I decided to write a book. I'd never written a book before. I thought it'd take me 6 months. It took me 5 years. Didn't know if it was any good, but like Terry said, when it was published, it did win the International Book Award as the best business personal finance book that year. Turned out there were over 1,000 entries from 15 different countries, and my book beat them all, and also won the Eric Hoffer Award. So it's a multiple award-winning book. I'm not even trying to sell it to you, because the stuff I'm going to share with you today, I think, is the most important stuff from my book. So, and also over the last 12 years, I've probably advised over 2,000 people, either married couples, divorcees, widows, or single people, helping them make the best Social Security claiming decision for their personal situation. And one of the things I realized before going into the meeting and talking to people is that they were about to make an uninformed Social Security decision when to claim it. And as a result, they're probably going to leave a bunch of money on the table in terms of lost benefits. So I put together like 4 things that I think everybody should know before they claim. And it doesn't matter if you're married, divorced, widowed, or single. Everybody should know these things. And I'm going to surprise you with some of them, because I've shown this presentation to over 75,000 people. And when I was doing live presentations, I'm back to doing them now. I had like a 2-year hiatus during the COVID crisis where I just did webinars. But after, I do big meetings, 300-400 people in the audience, and some of them knew a lot about Social Security. Not a lot of people, but some of them did. They always made a point to come up to me afterwards and say, "Hey, Brian, where'd you find this stuff?" Because they had done their own research. They had been to other seminars by Social Security experts. They said, "Nobody talks about the stuff you talk about, and some of it is really incredible. Why doesn't everybody talk about it?" I was like, "I don't know, but now you know. Be sure to go tell all your friends and families and work associates, because everybody should know this stuff." So let's get into this. And like Terry said, the title of this one is 4 things everybody should know before they claim, but also it could be the 4 reasons why not to claim benefits at age 62. Now, when I get done with this, you may think that all I want you to do is wait till age 70. That is not the case. Like I said, I think people make uninformed decisions. I'm going to share with you a few things I think everybody should know before they claim. If you still decide to claim at age 62, that's your personal decision, but it won't be an uninformed decision. One of the things I realized when I was doing my retirement income planning training is that your Social Security claiming decision is going to be one of the most important retirement decisions you'll make. It will. A lot of people make uninformed decisions, and as a result, could end up making a poor decision. But the thing is, once you make it, basically you have to live with it for the rest of your life. So you want to get it right. So here's the 4 things I'm going to share with you today. I'm going to tell you exactly how much your benefit will increase for every year you delay claiming it past age 62. Most people know their benefit gets bigger, but they don't know by exactly how much. I think I'll surprise you with this. I'm going to also show you how to get the biggest pay raise every year in the dollar amount of your Social Security benefit for the rest of your life. I'll show you how to do that. Also, one of the most popular videos and papers I've written was why your Social Security benefit statements are wrong. It turns out they are wrong, but they're wrong in a good way. I think you're going to be happy when I show you how they're wrong. And then I'm just going to take a few minutes at the end and share with you the true meaning of life expectancy. And what I found is that most people underestimate how long they're going to live. They're always surprised by the true definition of life expectancy. And this is something you should consider when you're claiming your Social Security benefits. All right, so let's look at the first one. You know, you're probably aware, most people are, that you can claim your benefit as early as age 62. But if you do that, you're going to lock into the smallest monthly benefit every month for the rest of your life. Now, there's some math geniuses out there that crunch the numbers and put out white papers about what's the best age to claim your benefits. They'll tell you that claiming at age 62 is probably not the best decision to make. Or you could claim your benefit as late as age 70 and lock into the biggest monthly benefit every month for the rest of your life. And those same math geniuses will tell you that may be a better decision. Or you could claim at any age in between age 62 and 70. But here's the bottom line. For every year you delay claiming your benefits past age 62, your benefit is guaranteed to increase by 6 to 8% per year up until age 70. Now, I call that a risk-free guaranteed rate of return. In this still pretty low interest rate environment, where are you going to find a risk-free guaranteed rate of return of 6 to 8% per year? Nowhere that I know of. You know, this really is an incredible deal. And I tell people it's one of the best deals out there. And you know what? The deal gets even better because, as you're about to find out, Social Security has this great inflation hedge called COLA, which increases your benefit a certain percentage every year, depending upon the rate of inflation. So for every year that you delay past age 62, you get that 6 to 8% guaranteed increase, and you also get the COLA increase on top of that 6 to 8%. Let me give you a quick example of how this works. Let's say in December of 2021, you turn 62 and you decide, you know what, I'm going to continue to work. I really don't need to claim my Social Security benefits. So you're going to delay claiming for at least one more year from 62 to age 63. Well, by delaying that 1 year, let's assume you had a full retirement age of age 67. By delaying that 1 year from 62 to 63, you got a minimum guaranteed increase of 7.14%. That's your guaranteed increase. Now, the COLA increase in 2022 was 5.9%. So you add the 5.9% to the 7.14%, and that increased your benefit by a total of 13.04%. You got over a 13% increase in your benefit amount just by delaying 1 year from age 62 to age 63. And you lock into that increased benefit for the rest of your life. Now, let's say at the end of 2022, in December, you turn 63, but you decide to still work and you still don't need your benefit. So you're going to delay for 1 more year, an additional year from age 63 to age 64. Well, by doing that, you got another minimum guaranteed increase of 6.67%. Now, the COLA increase in 2023 this year is 8.7%. So you add the 8.7 to the 6.67, and that increases your benefit by another 15.36%, over a 15% increase just by delaying that 1 additional year. That's pretty incredible. So to recap, just by delaying those 2 years, from age 62 to age 63, you got a 13.04% increase. From age 63 to age 64, you increased it by another 15.36 for a total increase of 28.4%. Actually, it does compound a little bit. It brought it up over 30%, but we'll just use the 28.4%. Just by delaying 2 years, from age 62 to age 64, you increased your benefit by over 28%, and you locked into that increased benefit for the rest of your life. This is an incredible deal. And you know what? And if you continue to delay past age 64, you're going to get, another minimum guaranteed increase of 6 to 8% per year, and any COLA increases on top of it. So in this situation, if we assumed you had a full retirement age benefit of $2,500, that's if you waited till age 67. We assume you have a full retirement age of 67. You wait there, you get $2,500. But if you claim at age 62, they're going to reduce your benefit to $750 a month. But based on delaying till age 64, you would have increased your benefit to $2,329 a month. That's a pretty good deal. So, and if you claim at age 62, you don't get that 6 to 8% minimum guaranteed increase, and you don't get any COLA increases on top of the 6.8%. So you miss out on that. So it really is an incredible deal. And look, I tell people, or people say to me, Brian, but I can't delay to 68 or age 70. I said, okay, that's fine. But if you can delay for 2, 3, 4, 5 years, your benefit is going to be so much bigger than claiming at age 62 because of the 6 to 8% minimum guaranteed increase and any COLA increases on top of it. It's a great deal. All right, so now let me show you how to get the biggest pay raise every year for the rest of your life in your Social Security benefits. And this has to do, again, with this cost of living adjustment feature from Social Security COLA. I call it the best inflation hedge around. And you know what? If you were to purchase this, because you can buy investment products that pay you income, and you can purchase an inflation rider where your income, it would guarantee your income go up by 2, 3, 4, 5% a year. But it turns out to be that they're very expensive, and they are. Now, when I did my research and I found out that Social Security has this cost of living adjustment feature, which is the best inflation hedge around, and they give it to everybody that's collecting Social Security for free, I was blown away. I call it one of our government's greatest gifts because it really is. And for most people, it's going to be the only pay raise they get in retirement. Now, when you were working, or if you're still working, you probably got a pay raise every year. And you wanted that pay raise to be as big as possible. I don't think anybody went to their boss and said, you know what, can I get the smallest pay raise possible? Nobody would do that. But that's exactly what a lot of people do when it comes to claiming their Social Security. They lock into the smallest pay raise possible for the rest of their life. Let me show you how to change that. Now, this is a pretty simple but very powerful concept. In order to show you how this works, I am going to just go to this chart up here. These are monthly benefit amounts, all right? So I'm going to contrast if somebody were to claim their Social Security at age 62, and if they do that, they go to their Social Security benefit statement, and their benefit statement says, well, if you claim at age 62, we're going to pay you $1,875 a month. But if that same person were to wait till age 70 to claim, they go to their Social Security benefit statement and says, if you claim at age 70, we're going to increase your benefit to $3,300 a month. Now, the difference between these two amounts starts off at $1,425 a month. If they claim at age 70 as opposed to age 62, claiming at age 70 will pay them $1,425 more a month than had they claimed at 62. Now I'm going to take you out here, this column 20 years later. I'm going to go 20 years in the future, and I assumed an annual COLA increase of 3%. Why did I choose 3%? Because that's the 75-year average for inflation, 3%. So this $1,875 a month, 20 years later, with an annual increase of 3%, it grows to $3,386. This $3,300 a month, 20 years later, with an annual increase of 3%, that monthly benefit grows to $5,959 a month. And now the monthly difference between the two has grown to $2,573 a month. Look, everybody gets the same COLA percentage increase. It doesn't matter when you claim your benefits. But if you apply that same percentage to a bigger benefit, it results in bigger dollar increases every year for the rest of your life. If I were to take this column out 25 or 30 years, that difference would grow bigger and bigger. You apply the same COLA percentage to a bigger benefit, it results in bigger dollar increases every year for the rest of your life. So how do you get the biggest pay raise in retirement? Delay claiming your benefits as long as possible, ideally until age 70. That'll get you the biggest pay raise every year. You want to get the smallest pay raise every year for the rest of your life? Claim your benefits at age 62 and apply that COLA percentage to the smallest benefit possible. All right. So, when I was about to have my book published, I had some really smart people proofread my book, really smart math people, and make sure the math was correct. And some of them came back to me and said, hey, Brian, we understand this, apply the same COLA percentage to a bigger benefit, get bigger dollar increases, but you have a major, major flaw in your analysis. I said, I do. What is it? They said, well, right here, go back to this chart. You have this person claiming at age 62. Then you take them out 20 years later. If you add 20 years to age 62, it brings you to age 82. Now you have this person claiming at age 70. And if you bring them out 20 years into the future, add 20 years to age 70, it brings you to age 90. Brian, you're not comparing apples to apples, but if you were, you'd have to look at what this amount, 59.59, would be at age 82, not age 90. It's going to be a lot smaller than 59.59, and the difference is going to be a lot smaller, and you're going to make the case stronger for claiming early. Now, on the face of it, it seems like a really valid point, but it's not a valid point because of the incredible way that Social Security credits COLA if you delay. Now, when I first read about this on the Social Security website, and it's on the website, but it's a massive website, it's hard to find. I said, wait a minute, I can't be reading this right. Nobody can do this. So I reread this part 4, 5, 6, 7 times. I finally realized I am reading it correctly. And I also realized that only the federal government can do what I'm about to show you. Nobody else could do this and stay in business that long. So this next slide is going to be worth you taking the time and viewing this presentation. This is the slide. Well, I've shown this whole presentation to over 70,000 people, but this is the one that everybody comments on. This next slide, actually, and says, where did you get that? I've never seen or heard of that before. And it's really incredible. It's amazing. And it is. So, over the years, I've done a number of videos, 3 to 5 minute videos, put them up on YouTube, get, 7, 8, 10,000 views. Who cares? I've also written articles. I did one about 3 years ago that was my most popular video. And the name of it was Your Social Security Benefit Statements Are Wrong. You can still go up on YouTube and watch it. Like 25 times more people watch this one than any other one I did. And it turns out your benefit statements are wrong, but they're wrong in a good way because your actual benefits are going to be substantially bigger than the amounts that appear in your statement. So here's how it works. Now I'm going to take you up here. Let's just focus on this little chart up here. And I'm going to assume this is your old Social Security benefit statement. Now, it used to be your old benefit statement only showed you 3 benefit amounts. Now, it shows you every benefit you could receive from every age between 62 and 70. But to illustrate this, I'm going to take you back to the old statements. All right, so everything used to play off your full retirement age benefit. I'm going to assume you have a full retirement age of 66. And if you go to your Social Security benefit statement, it says, well, if you wait till age 66, we're going to pay you $2,500 a month. The second benefit amount, it will show you if you wait till age 62. They said, well, if you claim at age 62, we're going to decrease your benefit to $1,875 a month. The third benefit amount, it'll show you if you wait as long as possible, age 70, that's the biggest benefit you could get. It says if you wait till age 70, we're going to increase your benefit to $3,300 a month. Now, I'm going to take you down here. Column A, we have the claiming ages between 62 and 70. Column B, I show you what happens if you do claim at age 62. You start off at $1,875 a month, and it goes up a little bit every year because of the annual COLA increase. Now, check this out. If you wait till age 66, you're not going to get $2,500 a month. Nuh-uh. You're going to get $2,813 a month. Why? Because if you wait till age 66, Social Security is going to take this $2,500. They're going to go back in time to when you were age 62. They're going to see what the COLA percentage increase was for that year. They're going to apply that COLA percentage to the $2,500. Then they're going to take that new bigger benefit. They're going to go back in time again to when you were 63. They're going to see what the annual COLA percentage increase was for that year when you were 63. They're going to apply that percentage to the new bigger number. In fact, they're going to do that for 4 years in a row. So if you wait and claim at age 66, you're not going to get $2,500 a month. You're going to get $2,813 a month. Why? Because you're going to get 4 years of what I call retroactive COLA credits. Now, the story gets even better. It gets a lot better if you wait until age 70. You're not going to get $3,300 a month. You're going to end up getting $4,180 a month. Why? Because you're going to get 8 years of retroactive COLA credits. Now, ladies and gentlemen, that's incredible. And nobody knows that this is the way it works, but it's absolutely the way it works. And this is why people come up to me and say, Brian, what are you sure this is the way it worked? People that know a lot about Social Security because they've never seen or heard of this before. And I'm like, yes, this is absolutely the way it works, and everybody should know it. I say nobody knows this, but I presented this to 75,000 people. They all know it, and now you know it too. Your actual benefit amounts are going to be substantially bigger than the benefit amounts that appear in your statements. And the only way you benefit from retroactive COLA credits if you delay claiming your benefit past age 62. If you claim at 62, you don't get retroactive COLA credits. You claim at 63, 64, 65, 66, all the way up to age 70, you benefit from retroactive COLA credits. And just real quick, some of you may do that, the break-even analysis where you say, oh, geez, Brian, if I wait till age 66, yeah, I get $2,500, but how long does it take me to make up for the 4 years of benefits I didn't receive because I could have claimed them at age 62? Yeah, the benefit amount is lower, but I received 4 years of these benefit amounts before I claim at age 62. And I get asked this question all the time. And, they do the calculation. Actually, mostly guys ask me this question and they already think they know the answer. They say, oh, it takes 12 years. So if I wait till age 66, it'll take me to age 78 to break even to make up for those 4 years of income I didn't receive. I don't think I'm going to live that long, so I claim at 66 or 62. But everybody calculates their break-even age wrong. They calculate it too high. Why? Because they use these benefit amounts on their Social Security benefit statement, and these at 66 and 70 are too low. They need to assume some rate of COLA increases, and with that, their benefit amounts are going to be bigger. And if they use these bigger benefit amounts to calculate their break-even age, you're probably going to bring it down anywhere from 2 to 4 years. Everybody calculates that wrong because they don't know how retroactive COLA credits work. So again, some people say to me, hey, Brian, I can't wait till age 70. I said, that's fine. But if you can delay for 2, 3, 4, 5 years, your benefit is going to be so much bigger than claiming it at age 62. One, because of the 6 to 8% minimum guaranteed increase, and because of these retroactive COLA credits. Pretty incredible. All right. So now I just want to spend a couple minutes talking about life expectancy, because I found out the true meaning of life expectancy about 15 years ago, and I was surprised. And most people were surprised when I show them the true meaning of life expectancy. Look, if we put men and women together in this country, they have a life expectancy of around age 78. And I think that most people think, because life expectancy is age 78, that most people die by age 78. That's not it. Life expectancy is simply a statistical term. It's a mean average. And what it means is that 50% of people are going to die before age 78, but 50% of people are going to live up to and beyond age 78. And I tell people, if you're doing any kind of retirement income planning, there's a 50% probability of you living up to and beyond age 78, well, then you should plan on that happening. But that's only one aspect to life expectancy. There's a second aspect to life expectancy that hardly anybody knows, and that's this. The longer you live, the farther out you push your life expectancy. So here I have a chart. I got ages on the bottom ranging from age 65 all the way up to age 105. And here on the vertical axis, I have the probability of living to those ages, okay? So if a man lives to age 65, we're going to go up to the 50% probability, which is the definition of life expectancy. if a man lives to age 65, he pushes his life expectancy out to age 84. If a woman lives to age 65, she pushes her life expectancy out to age 86. And there's a 50% probability that at least one of them will live to age 90. And for all the guys on the call, I got some really bad news for you. If anybody's going to live to be age 90, it ain't going to be you. It's going to be all the women on the call, because women overwhelmingly outlive men. It isn't even close. If you look at the number of men and women alive at age 85, there are twice as many women alive at age 85 than there are men. There are 3 times as many women alive in their 90s than there are men. And if I take you back to the 2010 census, there were 53,000 people in this country age 100 or older. 44,000 of them were women. So women live longer than men. Social Security is a bigger issue for them because they receive their benefit payments for a longer period of time because they live longer than we do. And you know what? Every woman should be cognizant of this. You know, especially, well, every woman should, but if you're a married woman or a divorced woman, when it comes to survivor benefit, you should know how the survivor benefit works. And because 95% of all survivor benefit checks go to women because they live longer than their husbands do or their ex-husbands. It's a critically important thing. But men, it's not totally bad news for you because you still have a high probability of living into your mid 80s. And most people in general underestimate their life expectancy by about 5 years. Most people think that, they're going to live to be about age 80. And if I can move that needle, I'm not trying to convince you that you're going to live to be age 90, 95 or 100, but if I can get you to think, hey, you have a high probability of living into your mid 80s, I think I put you in a position to make a better Social Security claiming decision. So, I'm going to recap, and I got to move mine. So the 4 things you should know, I shared with you exactly how much your benefit is going to increase by every year you delay claiming past age 62. You get that 6 to 8% minimum guaranteed increase, and any COLA increases on top of it. If you claim at 62, you don't get any of those. I showed you how to get the biggest pay raise every year for the rest of your life. That whatever that COLA percentage is, you apply it to a bigger benefit and it results in bigger pay raises. You want the biggest pay raise, delay as long as possible to age 70. You get the biggest pay raise every year for the rest of your life. You want to get the smallest pay raise, claim at age 62. But every year you delay claiming past age 62 is going to increase your pay raise for the rest of your life. Your Social Security benefit statements are wrong. I showed you how retroactive COLA credits, they're incredible. Hardly anybody knows it works like that. And the only way you benefit from retroactive COLA credits is if you delay claiming your benefit past age 62. You don't benefit from retroactive COLA credits if you claim at age 62. And then I shared with you the true meaning of life expectancy. You're probably going to live longer than you think. You have a good chance of at least living into your mid 80s, women living longer than that. So you should take that into account when you claim your benefits. And the longer you delay, the bigger your benefit is going to be, and you'll probably receive it for a longer period of time. So those are the 4 reasons. Now, I'm going to open up for questions in a minute, but first, I just want to say that what we're going to do is we're going to send you either today or tomorrow or by Thursday an additional paper that I wrote, one for women, that the 5th thing that every married woman or divorced woman should know before claiming Social Security. There's a 5th reason. And we're also going to send men the 5th reason why you shouldn't claim Social Security at age 62. So you're going to get, each one of you going to get one of those papers. And next week, we're going to do another webinar on the spousal benefit. Now, over 80% of spousal benefits are sent to women. So all the women on this Zoom call should probably tune in to that presentation next week. Spousal benefit is an incredible feature about Social Security. A lot of people think it's pretty straightforward, but it isn't. There's a lot of nuances to it. And if you don't claim it at the right time, you could end up getting less than what you should and leave money on the table in terms of lost benefits. So every woman should definitely tune into that. And every married man or divorced man should tune into it too, to know how to take full advantage of the spousal benefit. So that's coming up next week too. And with that, If anybody has any questions, or Terry, did you see any questions in the chat box?
We have a couple here. Yep, they look like specific questions pertaining to these people's situations. So let's see if we can maybe give them some good advice.
Okay.
So Patrick here says, we have savings/investments that can be used to supplement pension to cover shortfall for 4 years. Assuming it would be better to use that and delay Social Security, but not sure what the loss is due to the decreased investment potential. So they would be taking $15,000 a year from investments as opposed to $75,000 a year from Social Security.
All right. I'm not sure if so 75,000 if they claimed like immediately and not had to take money out of their investments is, well, if your combined income is, I don't know what your ages are, it'd probably be hard to get that by claiming at 62. Combined income is $75,000 from Social Security. But anyway, if you have a pension and your pension isn't inflation adjusted, then yeah, you should go ahead and claim that first. If that helps you, provides you with income in order to delay Social Security, because your Social Security income is inflation adjusted. And if you're going to take income from your savings, if you have retirement accounts, say you're going to delay Social Security, where are you going to take the income to give you the income you need to live? I would suggest taking it from your retirement accounts first. And the reason I say that, because the income that comes out is going to be taxable. And if you're not working, hopefully your income's way down and your tax bracket, or the percentage of taxes you have to pay, is down. So when you take it out of the retirement accounts, it won't be as big of a tax burden. And the other thing with the retirement accounts, when you turn 72, you're going to have to start taking, you got to take those required minimum distributions. And the percentage that you have to take out at the required minimum distribution is dependent upon your life expectancy. So every year your life expectancy goes down, and the percentage that you have to take out, required minimum distribution, goes up. But that percentage is applied to your beginning balance at the beginning of the year. So if you take money out of the retirement accounts, to delay Social Security, you're going to drive those balances down. And when you have to take the required minimum distribution, that percentage is going to be applied against a smaller balance, and you'll take out less money and hopefully less of a tax burden.
Great. Patrick, I hope that helped clear some things up for you. He also said, while you were talking and answering that question, Brian, he says, we'll be moving 401 to Roth for 4 years. So hopefully that can.
Well, the Roth should be tax-free. The 401k, if it is a taxable account, you probably should take the income from there, or distributions from there first, to continue to delay Social Security.
All right, we're going to move on to Steve's question here. And Steve says, my spouse is 65 and has a much lower Social Security benefit than I do, thus making her eligible for half of my benefit at my FRA. Can she take Social Security now and claim her benefit? Sorry, can she take Social Security now and claim her benefit? And then when I turn FRA, can she get the spousal benefit?
Yeah, so I usually recommend that she could claim now, and if her full retirement age is 67 or 66 and 8 months or whatever, if she claims at 65, her own benefit will be reduced slightly. I mean, not a whole, because she's 65 years old. It will be reduced a lot less than had she claimed it at age 62. But she can claim her own benefit now. And whenever he claims, because she can't claim a spousal benefit until he claims his benefit first. When he claims that benefit, then she can switch to a bigger spousal benefit. All right. The spousal benefit is going to be slightly reduced as well, because if she claims her own benefit prior to full retirement age, it'll be slightly reduced, and it'll also slightly reduce her spousal benefit. It's going to be less than 50% of his full retirement age benefit, but it's still going to be pretty close. And I usually recommend doing that because the wife's benefit, they're going to receive for the shortest period of time, because once the first spouse dies, whether it's the husband or wife, that smaller benefit is going to stop. right? And the surviving spouse is only going to receive the bigger of the two benefits in the form of a survivor benefit. So if you continue to delay claiming the smaller benefit, you're going to shorten the period of time that you receive that smaller benefit even further. So, she could claim her own benefit now, and then when he claims, she could step up to a slightly higher spousal benefit. And I recommend doing that. The only downside to that would be if she claims at 65 and she's continuing to work. Because if you claim your benefit prior to your full retirement age, like prior to, say, age 67, if that's a full retirement age, and you continue to work, you're going to be subjected to what they call the earnings test. And if you make too much money, you're going to have to start giving back some of the benefits that you received. Now, in 2023, the earnings limit is $21,240. So if you have earned income, it's just earned income. It's not investment income. It's not rental income. And it would just be earned income for the wife. In this case, the husband's earned income, Patrick or Steve's, would not come into play for the earnings test, only the wives. And if her earned income exceeds $21,240, then for every $2 of earned income in excess of that amount, you'd have to give back $1 of received benefits. Now, that's only if you claim benefits prior to full retirement age and continue to work. Once you reach your full retirement age, you can claim your benefits, continue to work, make as much money as you want, and you'll never have to give back any of your received benefits. So I would recommend that if she's not working, she could claim her own benefit at age 65. And then when Steve claims, she could step up to the higher spousal benefit.
All right, Steve, I hope that answered your question for you. Yeah, great. Thanks, he says. Perfect. All right. We have one last question here from Tammy. And Tammy says, I retired from law enforcement at age 50. I am now 61. If I remember correctly, I signed something then saying that I would take Social Security at 62. Am I held to that? And she also says she has no other retirement except for her pension.
Okay. So I'm assuming that what they do is when you turn 62, they're going to decrease your pension by, I don't know what your Social Security would be at age 62. And basically it would be a wash, or I don't know if they're going to decrease it by a certain set amount, or you tell them what your age 62 benefit is, and that's what they're going to decrease your pension by. I mean, I've worked, I'm not an expert with this stuff, but I've worked with other police officers and firemen where that was the case. They'll kind of supplement until you're qualified for Social Security, and then decrease their pension by what you would get at age 62 from Social Security. I don't know if they'll hold you to that. They may at age 62. They'll say we're decreasing your pension, so go ahead and claim Social Security. I don't know if you have to claim it at age 62. Maybe you don't. You could continue to delay it. But I would assume they're still going to decrease your pension from the law enforcement. So, I mean, it would be up to you whether, you want to continue to delay if they decrease your government pension by what you would get at age 62. That's a tough one.
Mm-hmm. All right, Tammy, I hope that cleared a few things up for you. Oh, it looks like maybe she's typing something up for us. Thanks, she says. Awesome, Tammy. Sounds good. Okay, everybody, I think that was all the questions we had. So I think we'll wrap up here today, but thank you all for joining us for this webinar. We will be doing another one next week, all about the spousal benefit. If that interests you, keep your eyes on your inbox because we'll be sending out some sign-up forms, I believe this week or early next week. Is there anything else you'd like to share, Brian?
Nope, that's it. Thanks for tuning it in, and look for those. We're sending those articles on the 5th reason, or 5 things every married and divorced woman should know, and the 5th reason why you might not want to claim at age 62.
Mm-hmm. All right. Steve says, thanks, Brian. Great information. That's good to hear. All right, everybody, have a great rest of your, I believe today's Tuesday. Yes, Tuesday. All right. Have a good one, everyone. Bye-bye. Thanks for joining.
Bye. Are you still there, Terry?